Hi again, I'm Kortsch from the Monetary Trust Initiative, and on this video I want to talk about saving our community banks. Bear with me, I'm going to have to give a lot of background as to what this is all about, but I think there's some really important information here that will be relevant to you and where your money is and how you place it and what is happening to our banking system. So let's start with, okay, well, why bother saving them? What's it all about? They are the small local depository and lending framework for individuals and small businesses. It's your bank around the corner. They tend to be locally owned and managed. The board members are often members of the community. Depending on which federal agency you ask, and by the way, they all use different definitions, this can be up to 94% of all U.S. banks. We're talking thousands of banks here, okay? They are the lifeline for most small businesses. So that's most businesses. Businesses under, $1 billion, they use community banks. Most of what they do or did is what we call relationship lending. That is to say, it depends on who you are as a person, not just the collateral or whatever is there. It's because we as a bank, we know you. You're a long-term customer. Does that remind you of a past world? Anyway, that certainly is decreasing, isn't it? We're seeing less and less of that. Lending today, more and more is based on numbers. Actually, one number. It's your credit score. Hasn't worked very well, has it? I mean, if you look back at the 2007 and 2008 crash, where we're talking a crash of trillions, all based on credit scores. Brilliant. So we're going to increase that. We're going to do more and more of that because that was so wonderful. 12 million Americans lost their homes. And, wasn't that... am I being a little sarcastic? Maybe I'm being a little too sarcastic. Let me tone that down, all right? Larger banks consistently move their staff and they don't have the same relationships. So they have to rely on credit scores. I don't know about you, but when I go into my bank right here, which is one of the large banks because so much of what I do is international, the staff routinely change. And people that I used to know aren't there anymore. And so again, it's the number, it's the credit score. Board members of larger banks are mostly specialists. They're not local. They're IT professionals, they're lawyers, they're accountants. They're not brought on because they understand the local situation. They're specialists needed today because of where our legal banking regulatory structure is. All right, let's talk about that. Dodd-Frank came into being because of the 2007-2008 crash in order to supposedly strengthen our banking system. It's been wonderful. Since that time, since the Dodd-Frank Act came out, about 2,000 community banks have either folded or merged with another larger bank because there's absolutely no way they can handle this. Imagine being a small bank, all right? Here you are, and you're trying to run a business. You're trying to lend to people that you know, and suddenly walks in the regular, actually it's more like the FedEx man, and he drops a 1,000-page book of regulations on your desk. Heart attack. Well, almost. All right. Larger banks, they have reams of lawyers for this, but the smaller banks, they cannot afford it. The Economist magazine recently said that Wells Fargo, in the two legal centers that it has, one on the East Coast, one on the West Coast, receives 5,000 legal requests per week. Okay, can you imagine as a small bank trying to deal with that? Okay, you wouldn't get as many, I totally understand. Here's a chart from Fred, that is put out by the St. Louis Federal Reserve Bank, of the drop in the number of viable community banks. And you see it's going in one direction, all right? And I think it's time to stop that because the amount of financing that is available to new businesses, the entrepreneurial aspect of our culture, is simply not being financed by banks anymore. Today, it's aunts and uncles and grandparents and angel investors. But bank investing into small businesses simply doesn't exist anymore. All right? So Dodd-Frank was supposed to stabilize the banks, but instead we're seeing the destruction of the smaller banks. All right? It is an overreach by Dodd-Frank that I think really, really needs to be stopped. If we look at the Chicago bank structure of what a bank should look like, the difference would be unbelievable. We would see lower federal deficits and then debt. We would see less pronounced business cycles, okay? And the Great Recession would not have happened. The Chicago Plan, just to give you a background, was basically created during the Great Depression, so back in the 30s. And almost 100% of all the U.S. economists signed off on it. Okay? And many economists and finance experts to this day, they continue to champion it, saying, ladies and gentlemen, this is where we got to go. And one of the strongest of which in recent decades was Milton Friedman, no longer with us, sad to say. And there's extensive literature available on these aspects. And I'm going to explain this. So hang in there with me, will you please? Okay. Just a brief monetary overview, first of all. Essentially, all money today is created through debt as loans are taken out at commercial banks. We often call that deposit creation. It is not the Federal Reserve Bank which creates our broad money. Okay? And therefore, banks do not intermediate or recirculate money from savers, but instead it's backwards. Loans create savings, not savings creating loans. I've gone through this extensively before. I quoted a paper from the Bank of England. By the way, it's been so used, this came out in 2014, that they have now reprinted it at the end of 2016 because so many people have wanted this, where the Bank of England says, no, this is not how money is created. And 3 times in 4 pages they say it is taught incorrectly in university economic textbooks. Don't get me as to why we're doing this. Anyway, this demands an ever-increasing level of debt in order to have the money that we need in circulation for an expanding GDP with price stability. As GDP goes up, the amount of money that we have in circulation has to go up equally, or we're going to get either inflation or deflation, depending on whether the amount of money increasing or is decreasing relative to GDP. And by the way, debt, when we're talking about debt, is at all levels: governmental, corporate, and personal. Okay? Therefore, all US dollars, even those used internationally, are created through debt. So when you think of the US dollar as a reserve currency, okay, or used for criminal intent, all that expands the necessity for increasing debt. So you and I are saddled with a system that demands this. Okay? Historically, this hasn't always been the case. U.S. notes, which is what they were called, were issued by the Treasury Department under President Lincoln, which paid for the Civil War, built infrastructure. Poor people, you know, you've heard this over and over again, but this is so important to understand this. All right, plus other infrastructure projects, and about 238 million of them are still in circulation today. And they have saved billions of dollars in interest payments. You can look back at one of the videos I did previously, and I'll walk you through the math as to where we come up with that. All right, they are not backed by debt, okay, but they create a type of federal equity, which in federal accounting speak is called net position. They don't use the word equity. I don't know why. They call it net position, okay? By the way, this has gone to the Supreme Court. It's found to be perfectly fine. All right. So much for the monetary aspect. Let me give you just a quick banking overview, and then let me talk to you about what we can do, okay? So banks have the outrageous legal privilege of being able to commingle funds with their own customers. Just think about that. There is no other business in this country, in the world that I'm aware of, that is allowed to take customers' money and mix them with their own money and then go out and try to get money, make money off that commingled money. Okay? All right? Now that has to be the case in order for them to pay interest to depositors. I don't know if you ever think about this. So if you make a deposit in your bank account, well, these days we're not getting, we're getting 1/10 of 1%. But under normal conditions, when you make a deposit at a bank, you think you're going to get some kind of interest. Okay? Where do you think that money comes from? Because they mingle their money with your money and go out and invest it somewhere where you have no idea what they're investing it in, totally opaque, okay? And you don't know where those investments are going up and down, and you hope that they're doing a good job. Well, as we saw in 2007, 2008, we pulled the whole world down because they were not doing a good job, okay? These investments are opaque, and opaque meaning you can't see what the heck's going on, and risky to the customers. Because the customer, you, me, we think when we put the money in the bank, that the bank it actually has the money. We think it's, quote, in the bank. No, the money isn't in the bank. Otherwise, you wouldn't get any interest on it, okay? When you deposit money in your account, you exchange that for an IOU from the bank, making you an unsecured creditor. That's all. In case of insolvency, you have no further right to that money. Now, we have federal insurance systems, the FDIC here in this country, because people realize that there's a disconnect between what people think happens in a bank versus what actually happens. In our fractional reserve banking system, banks only hold a, quote, fraction of the assets, and that's what creates bank runs, because suddenly if a whole bunch of people want their money, the money isn't there. Okay, and that then becomes self-sustaining. The more people hear about it, the more you see it on news, you rush out there and say, oh my goodness, I want my money right now because I have no idea what's going to happen. The Federal Deposit Insurance Corporation, pardon my mouth, the Federal Deposit Insurance Corporation, FDIC, they're mandated, I hope you're sitting down, to hold only 1.15% of all the bank deposits in case of failure. So if several banks fail simultaneously, guess what happens? We as a taxpayer have to come up with it. By the way, that 1.15%, during the Great Recession, 2007, 2008, they couldn't hold it. And it was only just last year, the FDIC then increased the mandatory payments by the participating banks, which is all the, quote, national banks, all the banks under the Fed system. So they could get back to the 1.15%, because there were so many bank failures, they didn't even have the 1.15%. You got a handle on that? Ultimately, you and I as taxpayers, we are the one. We're on the hook for the, quote, full faith and credit of the U.S. government. All right. The purpose of the Dodd-Frank Act was to create legislation to stabilize the banking system against these types of systemic issues. By the way, after 6 years, and I'm shooting this in January 2017, just so you know the year, because you might be watching this several years from now. After 6 years, only about half of all the thousands of regulations, of all the thousands of portions of that law, have been turned into regulation. This is the difference between the law, which is passed in Congress, and the regulation, which is created by the various sections of the government, okay? The complexity of this law creates a burden on all U.S. citizens due to its cost. We are all paying for this, as well as forcing many smaller banks into mergers and bankruptcies. I already said that, because about 2,000 of them have folded since then, okay? And again, just to repeat, credit to many local businesses, and the general entrepreneurial activity is being greatly held back, curtailed as a result of this. All right. Let's have a plan, finally. Oh my goodness, all that bad news, let's have some good news. Here's my suggestion. Let's establish a new type of bank, similar to an SNL, a savings and loans, but with only 2 operating modes, which I'm going to call windows. That's what they call them in the World Bank. That's where I got that word from, okay? So the one window, so every bank would have this, that would be part of this. The one window is the deposit and payment window, okay, which would operate as a trust. So when you deposit your money in your account, it would actually be there all the time and could not be commingled with the bank's money or be invested in anything. That's the one window. The other window, the investment window, would be mutualized, meaning a series of mutual funds would be created by each bank separately. So every bank can create their own mutual funds, and a small bank would have, let's say, 10 or 15, and a big bank would have 150. So you'd have a mutual fund for car loans, a mutual fund for mortgages, a mutual fund for small businesses, whatever you want to define. And by the way, this comes from the limited purpose banking plan of Larry Kotlikoff, the former senior economist on the President's Council of Economic Advisors. So there are some serious people that are agreeing with this, all right? And then you, as a depositor, can choose which one of those mutual funds you put your money into. So let's say you deposit $100 into the depository window of the bank. You say, well, I'm not going to make any money on that. So you take $50 out and put it into one of those mutual funds where you get a return depending on the risk and everything else that you are interested in taking with your money. This creates total stability in this type of bank. No bank runs are possible because your money is always there on the depository side. If you move it across into the mutual fund side, then it's like any other mutual fund. By the way, during the 2007-2008 crash, the banks went bust, but not the mutual funds. Very interesting, all right? So here's my suggestion. Allow all banks, of whatever size, to convert voluntarily to this structure. Totally your choice. You like this? Go for it. You don't like it? Okay, you can keep on running the way you are. But here it is. In return for changing over to the Chicago banking plan, the government would remove all banking regulations, okay, including all of the banking portions of the Dodd-Frank. The things that are currently bankrupting these small banks would all be removed. They would simply be regulated under the SEC, the Securities and Exchange Commission, just as any other mutual fund, which didn't go bankrupt, remember? They would still continue to have the full privileges with the Federal Reserve Bank, all right? There you go. We've saved the community banks, okay, and taken the teeth out of the nasty parts of the Dodd-Frank Act without even having to change it, okay? By the way, to convert it, there's other good parts of this change. To convert it to a 100% reserve system, because remember right now we've got a fractional reserve, we've only got 10% of the money. So what we would do is coin the US notes that I keep on talking before, and use that to purchase the 90% of the assets that represent the cash that's missing in these banks that desire to convert, and then sell them back into the mutual funds created on the investment side. And Treasury, so that's you and I as taxpayers, we would gain through that by the value of the assets that we would be selling back into the mutual funds. It would be depending on how many banks decide to do this, it would be a major gain to Treasury, all right, which would reduce the deficit. So on a one-time basis, bank by bank, as they decide to do this. What are the long-term benefits? Well, you've got a systemic banking stability now within those that have chosen. Okay? And as it becomes obvious to banks that this is a superior method of operating, increasingly more and more will convert, decreasing the money creation under the current debt-based system. This would increase Treasury's capacity to issue U.S. notes, now dependent on changes in GDP, rather than desire of banks to simply increase their profits, just what's happening today. We would have less pronounced business cycles, greater stability. Money would become a modern version akin to the former gold standard, but instead of gold backing, it would be GDP growth dependent. Over time, this methodology would remove the deficit and then the federal debt as all U.S. notes issued accrue a seigniorage to the Treasury. By the way, I just want to say about U.S. notes, obviously 100 years ago they were all printed. Today we're talking all electronic. I mean, I just want to explain it. It's not like all of a sudden we're going to churn out the printing presses. That's not what it's all about. There's a plan for a incremental, voluntary stabilization of our banking system and benefits to us as taxpayers, and huge benefits to the small businesses in this country. Ladies and gentlemen, I'm Kortsch of the Monetary Trust Initiative. Thank you so much.